So you're working 70 hours a week, just like myself, paying bills, trying to grow your brand, but the next month, you might not be able to make payroll. Most businesses don't fail because they're not profitable. They fail because of one of the invisible mistakes that they're making. That is not looking at their books closely enough. As a CPA who has been working in the industry for the last 8 years, from six-figure startups to like public companies, I've seen exactly where people lose money. It's not because they're not making sales, but because of one financial blind spot they never saw coming. And in this video, I'll show you 5 deadly mistakes that quietly kills a Canadian business. Make sure to avoid them before it's too late. If you're serious about building a profitable business in Canada, hit that like button and subscribe, because every week I share real strategies and tax insights that can save you thousands of dollars. You can be making $20,000 a month and still be losing money. How? Because you don't even know your break-even point and it's already costing you a lot of money. Let me tell you about Mike. He opened a cafe in Edmonton. His first month sales were $18,000. It felt like a win. But by month 3, he was in a $35,000 hole. He didn't know his break-even. He didn't realize he needed minimum $15,000 just to cover rent, staff, and supplies before making a single dollar in profit. Your break-even point is the minimum revenue you need to cover all costs, whether it be variable or whether it be fixed. The BDC emphasizes that understanding your break-even as a range instead of a fixed number is essential. As costs evolve, your break-even shifts, yet entrepreneurs revisit this number very rarely. It's simple to get started. Here's how you calculate it. It's fixed cost divided by 1 minus the variable cost percentage. For example, if your fixed costs are $5,000 and your variable costs are 60% of sales, your break even is $5,000 divided by 1 minus 0.6, which works out to $12,500 in revenue. That's what you need to break even and not a dollar more. If you don't track this monthly, especially after hiring or taking on new expenses, you're flying blind. But that's not the worst mistake. This is another financial pitfall that trips up many Canadian businesses and quietly drains business owners in Canada. So you paid your full tax bill on time and the balance is zero. Then months later, you get a letter from the CRA saying you still owe money with interest. What happened? You ignored the installment trap. It's actually catching up very fast. One user on Reddit shared his story. They paid their full tax bill on time and the balance was cleared and everything was settled. Then 2 months later, the CRA sent a letter demanding 2 installment payments. They logged in and the balance was still zero. But now, 2 more important messages have popped up. It says, you must make installment payments. Here's how it works. If you owe more than $3,000 in the previous year, you must pay installments. That is advanced tax installments for the current year. They're technically due by March 15, June 15, September 15th, and December 15th. That's from Canada.ca, and it's not a rumor, it is not a myth, it is actually the rule. And if you don't pay on time, the CRA charges interest, and this interest gets compounded daily. That means even if with 1 month delay, this can really snowball because of the compounding effect. Here's how to avoid it. Calculate your estimated taxes every quarter and make voluntary payments even if the CRA hasn't asked yet. And set up tax savings account to stash funds monthly. I suggest most of my clients to put away the HST they receive as part of their income in a separate savings account. Not only are they able to earn interest on this HST, but because it's parked away during the tax time, there's no surprise how much HST and taxes they have to pay. And if you're relying on credit cards to cover business costs, that's the next trap you need to be aware of. So you're using your business credit card to cover payroll, rent, and supplies. But what if I told you that this one mistake could cost you 30% interest or even more? And it's not just hurting your profit, it's quietly killing your business. In fact, according to ISED Canada, nearly 27% of small businesses requested external financing in 2022, whether that's debt, leasing, or equity. And while it's not always bad, the real problem comes when you're financing payroll or day-to-day expenses on a 20% credit card. The Canadian Federation of Independent Business reports that average small business is paying 9% interest annually. That's over 2% above prime thanks to tighter monetary policy. Now, credit cards might seem convenient, but it's not always great. With a 21-day grace period, you can get trapped easily. And here's the trap. Once that 21-day period ends, rates can soar from 20%, 30% to 80% APR in extreme cases. That's not financing, that's financial quicksand. So what do? Use credit cards for rewards, but pay full balance every month. For working capital, apply for business line of credits as they come with lower rates that are perfect for payroll and inventory. Our firm actually specializes in looking at your working capital requirements and connecting you with the right banker to get your line of credit approved. And always keep in mind to sit with us to check your debt to income ratio and interest to income ratios in check. Now, the next mistake might sound small, but I've reviewed hundreds of small businesses and this one shows up all the time. It's not fraud, but it can still cost you tens of thousands of dollars. So you're a new business and you've hired someone to help you with your business. You call them a contractor. You pay them weekly, you set their hours, you give them tools, but the CRA, they see it as an employee and you could be on the hook for tens of thousands in CPP, EI, and back taxes. Recently, someone on Reddit shared that their employer told them that they were self-employed and labeled them as a contractor. But under the CRA guidelines, everything about the job looked like a regular employment. They were given a set schedule, they had no control over their hours, and no taxes were deducted from their pay. That's miscalculation in plain sight. Under the Canada Labor Code, workers are presumed employees unless they can prove otherwise. That burden, it's on you. I have seen in the past how important it is to classify the employees correctly. Otherwise, employers are at a risk of audit, forced reclassification, penalties, and distraction of legal battles that could take focus away from growing your business. So how do you avoid it? Use the CRA's control test. Check who controls the work, where is it done, when is it done. So if you're setting schedules, providing tools, or requiring exclusivity, they're actually your employee, not a contractor. True contractors use their own tools, set their own hours, and work for multiple clients. And yes, they get a T4A, not a T4. But here's another silent killer: not filing your corporate tax return. Even if you don't owe a cent, CRA still expects that the T2 is filed on an annual basis. This can snowball into fines and penalties if you don't do it. Here's the rule: all resident corporations in Canada must file T2 every year, even if you're inactive, non-profit, or made $0, because the penalties, they're brutal. One time, my client got an arbitrary assessment from the CRA for not filing HST and T2. He ignored the file, and what did CRA do? They actually ended up freezing his bank account until he was in compliance. And if you're late filing, you'll face up to 5% penalty on the unpaid tax right away. Plus, there's 1% per month for 12 months. And for repeat offenders, CRA takes it even further. Penalties can jump up to 10% of taxes owed, plus 2% per month up to 20 months. That's enough to wipe out your entire profit. So how do you avoid this? Set annual reminders. File every year with no exceptions. I try to set up a calendar invite 1 year in advance so I don't miss any of my tax deadline. And if you need help, reach out to us because I've helped a lot of people get back on track, avoid penalties and interest. And if you're not tracking these 5 mistakes, you're already at risk. So let's wrap this up with the most important part: the financial habits that don't just save you from a disaster, but also protect your profits. So first, separate your financial duties. If you're doing it all, paying bills, reconciling, approving, separate it. Second, review your credit cards monthly. Whether it be bank statements or credit card statements, looking at them monthly will help you flag some of the big ticket items that you didn't even sign up for. And third, set up audit trails and user access controls. Most of the time, multiple people are using the same accounting softwares, and you can't even find who made that mistake or how you can correct it and what is the audit trail. So make sure to have good accounting controls. So if you found this helpful, hit subscribe because I share tax and accounting strategies every week. And if you're unsure about whether your business is compliant or just want a second set of eyes, book a call with me. I've helped hundreds of small business owners fix these exact issues before the CRS shows up. Let's make sure your business doesn't just survive, it thrives.